Welcome back. You're still with us on Market Sell-Off. Let's get to the remainder headlines that we're tracking for you. Well, the fourth headline today is Adani Power's up close to 5% after it said that it was all set to acquire DP Power's thermal power plant for around 7,000 crore rupees. Rima joins us to fill us in with more details on that. Rima?
Well, I'm actually tracking Adani Power because they've agreed to acquire DB Power Limited for an enterprise value of more than 7,000 crore rupees. DB Power operates and runs a 2 into 600 megawatts thermal power plant in the Champa district at Chhattisgarh, and the acquired company DB Power had an annual revenue of 3,500 crore nearly in FY22. Now, the reason for Adani Power to acquire DB Corp's thermal assets is it will help Adani Power expand its offerings and operations in the thermal power sector in the state of Chhattisgarh. Back to you.
Well, Credit Suisse remain cautious on the Indian steel sector, and they have an underperformed rating on JSW and a neutral on Tata Steel. They believe that spreads are likely to revert to historical averages and also will be lower than what we saw in the past year. They see a risk to regional prices with weak Chinese property data. They have given three broad reasons on pricing. They see a significant risk to domestic steel prices, as they highlight that FTA prices are down by close to around $80 per ton. And 50% of Indian imports come in from FTA nations. Now, Indian steel prices are now at a premium of around 19% in comparison to FTA import prices. That compares with 2% historically. Additionally, they say that EU prices have corrected by close to around $40 per ton this month on the back of weak demand. Point number two, they state that coking coal prices, which was losing its way, has suddenly rebounded by more than $70 per ton. That's what will put pressure on spot spreads. And finally, Chinese net steel exports continue to remain elevated and were up more than 25% in the month of July, which is a risk for global steel prices. The problem is further compounded by weak data coming out of China. Put all these factors together, and Credit Suisse, they're fairly cautious on the steel space. Let's tell you about API Holdings, the parent firm of online pharmacy, PharmEasy. They have decided to withdraw its draft red herring prospectus filed with SEBI, citing volatile market conditions and strategic considerations as well. Yash Jain joins us to fill us in with more on that. Yash?
Well, looks like the route to Dalal Street wasn't an easy one for PharmEasy. That's because the IPO plans for this online pharmacy came to an end, at least for now, with an announcement from its parent company API Holdings suggesting that PharmEasy has decided to withdraw its IPO DRHP. Remember, this IPO document was filed with market regulator SEBI over a month ago. This IPO, of course, was very crucial for PharmEasy, as it would have helped the company raise about 6,250 crore rupees, the funds which were intended to be used towards debt retirement, also towards funding of its organic and inorganic growth opportunities. So, what happens to those objectives now? API Holdings has also said that PharmEasy will now consider launching a rights issue, which will be through issuance of compulsory convertible preference shares, or CCPS. These CCPS would be priced at about 100 rupees per CCPS, and that rights issue will open in the first week of September, will remain open for the entire month. Of course, rights issue will give the existing shareholders of PharmEasy an option to raise their stake into the company. But what will be important to monitor is that how this rights issue really values PharmEasy. Remember, this has to be compared to the recent valuation which happened just a year ago and valued PharmEasy at about $5.1 billion.
Thanks a lot for that, Yash. Well, on that note, though, we'll wrap up on this edition of Market Sell-Off. Thanks so much for watching.